Good evening.
Good evening.
Welcome to our class today. So today I want us to discuss on, I'm not sure what's the last topic that we were discussing the last time we met. The last time we met on Wednesday, what was the last thing?
Finance forecasting.
It was on forecasting.
Yeah, and we had 3 questions which you said we'll discuss in this session.
So we agreed again to do some few more questions. Okay. Okay, thank you for reminding me that. Okay, great. Before we start therefore this topic, then we can attempt some of those questions, which I think I sent to you. You have them with you, isn't it? I'm not sure, I guess there's some question I sent to you on our WhatsApp platform. Yeah, check them because I think I must have sent those questions to you. Okay, I suppose that you have gone through the question. So let's attempt to do it together. Okay, required. The external finance required for the 2 years. Okay, so this forecasting is for 2 years, not 1 year like we have been doing. Okay, and 2, you prepare the pro forma balance sheet by the end of these 2 years. Okay, so the process is the same. Okay, first step, you identify the elements of the balance sheets that will increase in line with the increase in sales, or rather that are related, that have direct correlation with sales. Okay, so goes all the assets and all the bits of the current liabilities. Okay, so therefore that's the first step. Step 2, determine therefore what the percent of sale for each of those accounts. Okay, let's begin with the non-current assets. Okay, non-current assets, the percent of sale will be equal to the sale for that year. This time of the 2011, the non-current assets were 87.2 million. Okay, we divide by the sale for that time, which was 360 million, and we get the percent of sale. Okay, and then we do the same for inventory. Okay, it will be the amount the company did invest for inventory, 57.6 million, divide by sale, 360 million, and we express as a percent. Okay, same for receivable. Will be equal to the receivable value for 3.2 million, divide by the sale for that time, that is 60 million, and we express as a percent. Okay, then you have cash. The investment in cash is 10.8 million, divide by the sale, 360 million, and we express as a percent. Okay, and then you have for payables, part of current liability payables. Okay, we got the payable, which is 54 million, divide by 360 million, the sales volume for that particular point time period. Then you have accruals, which is equal to the 6 million, divide by 360 million, and we express this as a percent. This gain give us 10%. This gain give us 15%. What about the others? Sorry, for cash, 3%.
Yes.
Receivable,
12%.
2%. Inventory,
16%.
okay, exactly. No, not enough. I hope so.
Yes.
Non-current assets,
52%.
2%. Okay, therefore that gives the the percent of sales for each of the accounts, which we have been able to identify all the way from non-current assets to the accruals. The next step, of course, determine therefore the increase in assets. Okay, therefore, step number 3 is asset increase. Okay, asset increase. First, we determine what will be the increase in sale. Okay, over those 3 years. Okay, so sales increase. If we do that, the sale will be increasing by 15% in year 2012, and then increase by 20% in the year later. So sales increase, therefore, will be equal to current sales, being told is equal to 360 million. Therefore, the sale increase for 2011, therefore, will be equal to 360 million, okay, times the increase, which is 15%. The sale increase for year 2013, no, these are 2 years, okay, will be equal to 360 million. The sale for year 2012, which is 360 million times 115%, okay, to give therefore the sales for 2012, okay, then they increase by 20%, okay, therefore times 20%, and therefore the sales increase over those 2 years, okay. This is sales increase for 2012. This is the sales increase for 2013, okay. They have the combined give therefore the total sales increase, which is how much?
The second one is 82.5.
82.5 billion combined.
136.5.
6.5
136.
136, so it is here.
Yes.
Therefore, within those 2 years, therefore, we extract therefore that the increase in sales will be equal to 106.5 million. Okay. So therefore, since the sales are increasing, therefore we do extract that the company need to invest more towards the assets. Okay, therefore, we need to determine therefore asset increase. We need to first determine the increase in non-current assets. Okay, so we begin by non-current asset increase. Non-current asset increase will be equal to 52%, to be 52% times the increase in sales, and that's 6.5. The increase in inventory, okay, will be equal to the percent of sale, which for inventory we got 16%, will be therefore 16% times 136.5 million. The receivable, will be equal to the percent of sale for receivable, which we got to be equal to 12%. Of 12% times 136.5 million. Then cash will be equal to, cash was 3%. 3% times 136.5 million. Okay. Then current asset increase.
Excuse me, sir, I'm getting the increase as 136.8 million.
136.8.
Yes.
Yeah, 136.8.
So what's the increase in 2013?
82.8.
2.8, not 0.5.
Yes.
Okay, 82. So, okay. So 82.8, 136.8. So we need to make an adjustment to all these figures then. Okay, great.
71.1,
21.1,
21.9,
21.9,
16.4,
16.4,
4.1.
4.1. No loud enough done. You didn't do loud enough, I hope.
They have been rounded off.
I've rounded off.
Okay, just give me the exact figures so that don't get, so we'd have the balance sheet balancing. So you get
Okay. 71.136,
136. Okay.
21.888,
888,
16.416,
416.
and 4.104.
104. That gives for the increase in the individual accounts. Total increase, therefore, is how much for those 4 accounts? One.
544.
544. Okay, like for the increase in assets between those 2 years. Okay, 113, 554,000. Okay. Next step, of course, is how do we finance it? Okay, the next step is about financing. So step number 4. Okay, financing. And you see that the financing for this asset increase will be done through. We first need to identify the internal sources first. Okay, so therefore, finance will be done as follows. So first is asset increase. The finance required. Okay, is equal to 113. Okay, 544,000. Okay, this will be financed as follow. So first we're going to use our own retained earnings. Okay, therefore first is from retained earnings. Okay, now these are 2 years. These are 2 years. So let me get the retained earnings for 2012. Okay, which will be as follow. The sale increased by the 20%. Therefore, the sale for 2012 will be equal to 360 million. Okay, times 115, which I think you've already done. Okay. Then the profit we made from this sale in O2, the profit return is 8%. Okay, therefore times 8%. Yeah, therefore this is therefore given therefore the net profit. However, the company pays 80%. Therefore, what remains as per note 3 is 20%. The company pays out of this profit, the company pays 80, the retain 20. Therefore, times 20%. Therefore, how much will be the retained earnings to be the amount that goes to finance the project in year 2012? The same applies for 2013. Okay, the sale for 2013 will be equal to 360 million times 115% times 120%. Okay, times 8% being the profit return, and then the company pays 80. It remains with 20%. Okay, therefore the retained earnings therefore for 2012, 2013. 2012.
6.624.
6 million.
6.624 million.
Okay, so that way.
Yes.
Okay, 2013.
7.9488.
9488. The way it is.
Yes.
Okay, great. Therefore, the sum total of those two retained earnings for those 3 years how much? 14 million.
570 to 800.
570 to 800. Okay. Okay. The companies will use this money to finance the asset increase. Okay. Therefore, the balance, okay, after subtracting the financing you just obtained from money, we need to check whether the current liabilities will also be financing. Okay, the current financials will also be financing the company. There is no overdraft. Okay, but we have payables here. Therefore, next we're coming from current liabilities, payables being the first one. The increase in payable, that is the increase in financing from suppliers of the company, for example, raw material, they'll be giving the company, okay, their percentage of sale is 15%. Therefore, we got the 15%, okay, times the increase in sale, which was within those 2 years, the sale increase was how much? 106,800, therefore 106.8 million. Therefore, that's the kicker of the payable, okay. The other financing comes from accruals, okay, accruals, where their percent of sales for accruals, we got 10%. Therefore, 10% of the increase. And here we get the two to give us 13.68 million. Okay. And for the case of payables,
$20.52.
520,000. That way. Okay, the two combined.
20.52.
20, not 30. 20.
It is 20.5.
Okay, the two combined give us how much? That 4 million.
34.2.
That 4.2.
Yes.
That 4.2 million, okay, that 4.2 million, because for the financing that will come from these two financials, the payables as well as the accruals. Is there a difference? Which I think there is a difference, okay, because this one 13, this 14, this 34, so therefore there's still a huge difference which need to be financed externally, okay. Now in note 4, any external financing will be through commercial papers. So here the difference is will be financed through commercial paper, okay. If the two financials, that is the retained earning as well as the payables and accruals, are not enough, the difference will be financed through issue of commercial papers, which is how much? Which is the difference? 113 minus 14 minus 34, and you get how much?
$64.
64 million.
771.
771.
2.2.
Sorry,
200.
200. 30.
Yes.
Okay, great. Okay, for the amount that need to be financed externally through the issue of commercial papers. Okay, so we're done with note 1. Okay, external financing required. And note 2, we need to prepare or call the pro forma balance sheet. That is, what will be the balance sheet status as at year 2013. Okay, now time that we do together. So we begin all the way from the first account, non-current assets, all the way to the accrued expenses. So closing balances. Okay, so these are the closing balances value as at the year 2013. Okay, non-current assets. what's the sales figure as at 2013? Okay, so they can hit the sales 2013. Okay, I think we saw 60 million times 15% times 20%. You got what? Sales figure for year 2013?
496.
496.8 million. Okay, not enough done there, I hope.
Yep.
Okay, therefore, the value for the non-current asset by the end of the year, therefore, will be equal to 52% times the sales value as at that year, which is 496.8 million. Okay, and then the value for inventory will be equal to the inventory value here is equal to 16% times the sales figure then it is 496.8 million. Then you have receivable. The value for receivable will be equal to the percent of sales for receivable, which is 12%. 12% times 496.8 million. Then you have cash, which will be 3% of the sales, 496.8 million. Then you have accruals, we have payables, which will be equal to 15% times 496.8 million. We have accruals, accrued expenses, which will therefore be 10% times 496.8 million. Give us therefore 49.68 million. Then we have retained earnings. Okay, retained earnings by the end of the year. Okay, it'll be equal to at the beginning of the year, end of year 2011, the retained earnings as per the balance sheet was 52.8 million, plus retained earnings for those 2 years, 2013, 2012, we got 66.24. Plus 2013 retained earnings, we got 79.48, 800. And that is it. Okay. And the current assets closing value
For non-current assets, it's 258.336. Inventory 79.488. Receivable 59.616. 59.616. Cash 14.904. Payables 74.52. Retained earnings
Retained earnings is how much?
67.3728.
3728. That way.
Yes.
Okay, great. Therefore, we have the closing balances for the from and current assets at retained earning. Okay, therefore now we can prepare therefore the balance sheet by the end of year 2013. Okay, therefore this is the pro forma balance sheet for Swere. Therefore, Swere Limited. Okay, pro forma balance sheet.
I'm finding my retained earning as 126.9888.
126.
0.9888.
That way.
Yes.
126,988.
Yes.
Are you sure? I'm doubting that because here we have 52.8 million plus 6 million plus 7 million. So check it again because I don't think it can be 126.8. Add them together. Try again. You see how much you're going to get.
$67.3728.
Okay, great. Okay. So therefore, that's what you need to prepare the balance sheet, okay, for the company, okay, as at the 2013, 30th of June, 2013. Okay. We can begin by getting non-current assets. Okay, we just report as it is from our workings above there. Non-current assets, we got the closing balance to be equal to 258,336. So 258,336, yes. Okay, then you have inventory. Inventory closing balance will be equal to 29,488. Then you have receivable. The receivable value will be equal to 59,616. Then you have cash, which you have obtained to be equal to 14,904. Okay, let's give the total assets of the company. Then financed by ordinary share capital, the company remained constant. Ordinary share capital. Which was 126 million. Then you have retained earnings to give us part of equity. Retained earnings we have from working above, we got 7,332, 67,372, 800, I suppose. yes, 372, 800, and that's this give therefore equity. Then you have non-current liability, non-current liabilities. Okay, we have 12% debt, 12% long-term loan, long-term debt, which we told is equal to 30 million. Okay, current liabilities. We have payables. And payables from a calculation above, we got payables to be equal to 74, 55, 520. We have accruals. Okay. Okay, accruals from calculation above, we got 49, 680, 680, yes, 49, 680. Total assets of company,
For 12,
sorry, for 12,
yes, 344,000.
344,000 for 12, 344,000. Equity, $181, 800.
I'm getting 193.
193, okay, plus 30. Current liabilities of this company is how much? $184, 200.
Yes,
Okay,
230.
sorry,
124 to 30.
124, 230. Where is that coming from?
The debt, the
Oh,
long-term debt.
okay, no, oh, this was only to represent the current liability, only the current liabilities. So don't add the 30.
Okay, okay.
Then we have the total, or that is equity plus then current liability plus current liabilities to give you therefore the total of equity plus liabilities. Can you get how much?
$317,602.
317. We forgot.
602.
We have forgotten commercial papers. Sorry, we forgot commercial papers, which I think we have already done the calculation. So we need to add commercial papers, which we have already done the calculation for it. Yes, thank commercial paper. But commercial paper are part of the current liabilities, okay, of the company, and we got what do you get? Commercial papers. They have here 64 771 200 64 million 771 200. Current liabilities.
Excuse me, sir, if I may ask, what's that commercial paper?
Yeah, the external financing, which you got here. Where was it? Where did you get it? Where was this? Yes, here it is. The external financing.
Okay.
Yes, because you're told that any external financing is going to be raised through a commercial paper. Commercial paper, don't forget, as we had mentioned earlier, it's one of the money market instruments, okay, used to finance the company for short-term needs. Okay. Clear?
Yes.
Okay, great. Okay, therefore, total current liability is how much, therefore?
$188,971,200.
Mm-hmm. Okay, then add with the current liability and the retained earnings and the equity. What do you get?
Okay. 15 times.
183 million plus 30 plus this 188. What do you get?
30,000.
That sorry, this is million actually. They're in millions, not thousand. They're in millions.
It's coming to 353.
353. No, it can't be 353. Because it's coming how much?
For 12,344.
For 12,344,000. Okay. For 12,344,000, is it bouncing? Yes, it is. Okay. Get 12,344,000. Therefore, to be the total of the equity plus the liabilities. And that's what you might have done in that particular question. Okay. So these are most of the time the free marks for sure. Okay. If you know how to get if you know the process, that is. Any question on that? Okay, no question. Okay, that's great. So I guess with here, how many questions have we done from the past paper on this area? On forecasting, we have done 2, I think. Is it? Are there 2 or 3?
2.
2. Okay. Okay. I think those are enough, I guess. There's 2 questions because even if we do another question, it's the same process that we have just discussed together. Okay. So any questions so far on that area? Okay, no question. Okay, that's good. So today I want we discuss on business valuation. Okay, valuation of businesses as well as valuation of financial instruments. Okay, so let's begin by discussing business valuation. Now, valuation or business valuation, it's simply attempting to determine what will be the value of assets of the company, or what will be the value of the company as in its entirety, or maybe the valuation of maybe a financial instrument, okay, valuation of an individual financial asset, equity shares, bond valuation, okay, preference share valuation, okay, that's what we'll be discussing in this particular topic, okay. Now, why would you want to do valuation? Okay, what would be the driver behind you wanting to either value the entire business or to value a given financial instrument? Okay, the number of things that may prompt you to want to value. Okay, one of them, for example, okay, the shareholders. Okay, there's an acquisition that is being flaunted. Okay, and you want to determine how much should I be selling my company out. Okay, there's some company would want to buy me out. Okay, to buy my company. Okay, therefore, how much am I willing, for example, to pay for my shares, okay, to pay for the shares that this company want to acquire in my business, okay. When there's a need, okay, there's another company who would want to acquire you. You may want to determine, okay, what's my as the owner of the business, okay, how much should I be? What's the minimum I should be willing to accept for my company based on its true value, okay. So you need to do that. You need therefore determine the correct valuation of your business, okay. And of course, in the case of if the company is deciding to either go to the market to float shares, okay, issue shares, okay, the company want to issue its shares in the market, an IPO, okay. Definitely, you need to value to determine what's the value, okay. You don't want to go to the market and you sell your company at a very low price, okay, because you're selling your shares. You as the owner, you as the current founder of the company, if you decide to go to the market and sell off your company, don't forget to again be determine what is therefore amount will be receiving from the sale of this company. Okay. Also, in case the company is being broken down for liquidation, okay, maybe that's something else that you want to consider. Okay, what's the value therefore of the business, or what's the value, or even a department? Okay, the company wants to sell a department. Okay, now you have cases where the company sell off a department. Okay, if you have let's say case you are Unilever, okay, you make different diverse products. Okay, you may decide maybe this product is not doing well for us. Let's dispose it off. Let's say sell it off. Okay, and that's therefore that particular case. Okay, you may want to consider therefore what is the value of this particular business sector we are involved in. Okay, If you're making Omo, okay, what's the value of our Omo as a brand, as well as the machine that makes all this entire product, okay? Also, in case the company want to use their shares, okay, as a collateral, okay? They want to use their shares as a collateral, as security against the loan they're currently acquiring, okay? That's another driver of you wanting, okay, to know therefore what's your value, okay, as a business, okay? Because if you're going to be using your shares as a collateral, then in case of failure to pay, then don't forget the owner of the financier will come and become a shareholder of the company. They're going to be taking up your shares, okay, because you use those shares as security, okay? So in case you did add a value company, okay, if you did not give the shares were undervalued, maybe for instance, okay, therefore they're going to be acquiring more than even what they deserve, okay, in case you fail to pay the loans, for example, okay. So all the reasons and many other reasons, okay, you may want to determine, okay, or you may want to determine therefore what's the value of what of our company, okay, of our department, okay, of our branch, for example, okay. So the need for valuation is therefore quite diverse, okay? It's quite diverse, okay? In the case of partnership, in case one partner would want to leave the partnership, okay, and the others don't want to liquidate, okay? So they want to pay off this old partner, the one who want to exit the partnership. You need to have the value, okay? You as a current partner who would want to continue with the partnership, for example, okay? How much is the value you're going to be? What's the value of the business, okay? So that you want to pay off this partner who want to exit, okay? So therefore, you want to tell me what's the value of his stake in the company, okay? So in case his stake is 10 million, you can't pay him 20 million, okay? But how will you know it is 10 million? You need to do the valuation of your partnership, for example, okay? So those are therefore need for you carrying out the business of determining the value of your firm, okay? Clear? Question? Okay. Now, the different method you can use when it comes to business valuation. Okay, the number of methods which you can use when it comes to business valuation. Okay, the first is called the use of the net asset value method. The net asset value method. Now, in this method, the use of the NAV. Okay, the company will determine the value of the company based on its net asset, as the name is suggesting. Okay, we determine what is the excess of the company, total current asset over its what is the company total value of all its assets over its liabilities. Okay, what remains if the company assets were to be used to pay off their obligations? What will remain? What is the shareholders' value in short? Okay, if the company was closed down today, okay, all the shares or all the assets of the company are disposed of, and the company receives the shares. The company receives pay off the liability. What would remain? Okay, what would the shareholder say they own in this particular company? Okay, so it's simply the total excess of the total asset of the company over total liabilities. Okay, the first method we should discuss together. Then you can also use called the income-based valuation. Okay, the income-based valuation. Two of them are the use of the PE ratio method and the use of the earnings yield method. Okay. Then you can also use that method, which is going to be the conventional method used, is use the cash flow based valuation. Okay, cash flow based valuation. Okay, which you can use two method. Okay, the use of discounted cash flow method. Okay, the use of discounted cash flow method, which I think we will discuss, the NPV method, which is still part of discounted. Okay, as well as the use of valuation of bonds. Okay, which also follows here. Okay, under the fundamental theory of valuation, which I think we did discuss already, so I will not go through it again. Okay, how we value bonds. Okay, fundamental theory, which is applied in bonds valuation. Okay, so let's begin with the first method, the use of the NAV method, the net asset value method. So in the net asset value method, the NAV method, the company value, okay, we determine the company's value to be equal to the total asset of the company, as we mentioned, the total assets of the company minus company total liabilities. Okay, so what is that excess? Okay, in short, if the company was to be closed down, if the company was to be closed down, okay, what would be the total assets of the company? Okay, what would remain? Okay, after the company uses the funds it receives from the disposal of its assets to pay off its obligations, both current and uncurrent. Okay, okay, it's simply equity. Okay, it's simply the equity of the company. Okay, the NAV is simply like the equity of the company. Okay, even though we can use different bases. Okay. what we call the NAV. Okay, NAV is simply equal to the net tangible asset of the company divided by its assets. Okay, and generally we avoid using the intangible assets. Okay, we avoid using the intangible asset. Why? Okay, the intangible asset company. Generally, we avoid using the intangible assets of the company because unless those intangible assets can be able to fetch their market value, it is possible for us to be able to get their current market value. Then we avoid it as much as possible. Okay, because if they don't give us the, if it is not possible for us to dispose of this current asset, if it is not possible to dispose of this intangible assets in the market, okay, then we avoid using them. Okay, because here, when it comes to using the NAV, okay, the conventional method we use is we determine if this asset of the company, we go to the market, we make an announcement, hey, we as company ABC would want to sell off our assets, okay, how much can they fetch in the market, okay? If we say that we have a motor vehicle with this, with the following details, okay, A, B, C, and D, okay, how much is the market willing to pay for it, okay? Therefore, in most cases, the market doesn't pay for the intangibles. Okay, that's why therefore we are saying that we avoid it. Okay, for example, if you have a goodwill in your balance sheet, okay, you have a goodwill worth 10 million. Okay, you can't go to the market, tell the market, hey, I want to close down my company, but I have goodwill here worth 10 million. Who is going to pay for goodwill? It's nothing. It is an intangible. It has no value as per se. Okay, the company is closing down. Okay, so therefore we avoid the case of those intangibles. Okay. Maybe you can include intangibles whose, maybe for example, the patents and copyrights, okay? You have research products you have, okay? Research articles you have, which have market values, okay? So in case you have those intangibles, okay? Patents as well as copyrights, okay? Now those one, this one you can sell to the market at their market value, okay? Those are not possible. So in case you have those intangibles, okay, which is quite unlikely, you have those intangibles that have their own individual market value. The market can buy them off, okay? Then there are those those one you can therefore include in the analysis. But generally, we avoid including the intangible assets, okay? That don't have their own individual market values, okay? So generally, notice that the use of the NAV method, the net asset value method, okay, give us what we call the minimum or the floor value of the company or the firm, okay? Because we are assuming that, hey, the company is closing down, okay? Therefore, we don't have to call the going concern value, okay? The company is closing down, okay? So therefore, you can't sell, like I've mentioned, you can't sell a goodwill, okay? But in case the company was a continuing company, then you can go to the market and say, tell the market, hey, I want a goodwill worth X amount of money, okay? I want this particular goodwill, okay? Because of maybe because of my location, my good relation I have with my customer. So you can go to the market actually and say that my value, the asset I'm selling to you is worth 10 million. However, I require 15 million. What's the extra 5 million for? For the goodwill, okay? So it is possible some cases, sometimes you can have that case, okay, where the goodwill is being asked for. However, if you're closing down, then there's no goodwill you can ask for, okay? There's no goodwill you can ask for, okay? Therefore, the use of the historical cost method. Okay, the use of it gives the minimum value of the method. Okay, so most of the time, okay, it is based on what we call the historical cost basis. We use what we call the historical cost basis. Okay, therefore we use what we call the book values. Okay, we use the book values. Okay, what does that book value means? We simply go to the balance sheet. Okay, determine what is the company asset position. What's the company total asset, both current and non-current. Okay, minus the company total liabilities. Okay. Actually, the NAV is simply the net asset value, okay, is given us net asset of company, don't forget, is equal to total assets of the company is equal to total assets of the company minus total liabilities, okay, minus total liabilities. So you just go to the balance sheet, okay, what's total assets, okay, what is total liabilities, okay, that therefore give us therefore the net asset value of the company, the net, the NAV, okay. So as mentioned, we normally use the historical cost basis, okay? We normally use the historical cost basis, okay? Where you see that the total assets will be their book values, okay? So if you have to go to the balance sheet, okay, what was the total book value of the company, fixed asset? What was the total value of the company liabilities as per the book value, okay? Therefore, use the book values, the use of the historical cost basis, okay? So the assumption is that the market is paying you based on their book values, okay? which is quite unlikely. Okay, but that's the case here. Okay, we use the book values of the assets, okay, to determine therefore the NAV. We can also use the days of the replacement cost basis. Okay, you can also use the replacement cost. Okay, now in the replacement cost basis, okay, what we are assuming is that if the company you are to make an exact replica, okay, if the company was to replace the asset of the company, okay, in the exact measure, okay, in the exact way, okay, what therefore would be the replacement? What therefore would be the amount the company is paying, okay, would pay for it? If you have a motor vehicle worth 10 million, okay, or worth a motor vehicle who has the following details, okay, bought in the year 2010, what's its model, okay, Toyota this and that. Now, if we have to make an exact, you have to replace that same exact asset you have from the market, okay, how much is the market willing to sell it to you, okay? So we're getting the concept here on the replacement cost basis, okay? If we are to make a replacement of all your assets, okay, how much would you be paying for them? Okay, how much is the market going to be asking for those assets? Okay, if we are to go to the market and try to seek exact assets, okay, they'll call the use of the replacement cost basis. Now, in the case of the realization basis, the use of realization basis, okay. Now here we are the ones selling the asset to the market. If we go to the market and sell and inform the market, we are the following type of motor vehicle. Okay, how much is the market willing to pay for it? Okay. Therefore, you're going to be determining the amount that the market will be, the amount the market is willing to pay for your assets. Okay, the use of realization. We are disposing of these assets in the market. How much is the market willing to pay you for those assets that you have? Okay, therefore, those are the three bases you can use. Okay, replacement, realization, and you have the historical cost basis. Okay, so be careful because all these three bases give you different NAV. Okay, be quite careful on what method you're being asked to use. Okay. Most of the time, okay, we're going to use the realization method or the use of the book basis. Quite unlikely we'll be using the replacement cost basis. Okay, it's either use of the replacement cost basis, okay, realization basis, and the use of the historical cost basis. Those will be the two methods normally we use. The NAV generally, okay, as mentioned, it sets the floor value, okay, therefore the minimum value that as a business you are willing to accept, okay. That is in case the person gives lower value than that, then you don't consider for it, okay. Then assets backing for assets, okay, asset backing for shares, okay. In the case I think we mentioned this, in the case of collateral, I think we mentioned, okay, you want to use your assets, okay, as you want to use the asset for shares, okay. You want to use them as security, for example, okay. Also can be used in the midst of comparison in the case of mergers and acquisition. Okay, in the case of merger and acquisition, if you have two companies, okay, and you have intangibles, okay, it doesn't matter to the two of you, okay. What really matters is what do you bring on the table, okay. You as company, okay, we want to form a new company, okay. You as CBA, you as NSC, okay, and NIC, okay. What do you bring on the table, okay? These are my assets I bring, okay. These are my liabilities I bring, okay. The two of you, okay. There was your value. Your value might therefore be based on what you bring on the table as the CBA or to bring on the table as NIC, okay. The intangibles in that case, therefore, that don't have market value may not matter so much, okay. Provided you're bringing, we ask you what asset do you bring on the table, okay. So therefore, in case of mergers and acquisition, this may be a good proposal to value the business, okay. In case of mergers, for example, okay. And that's the use of the NAV method, the use of the net asset value method. Simply determining what's the excess of assets over liabilities, or the excess of assets over liabilities. Of course, this method has its own weaknesses, okay. For example, as we have mentioned, it ignores intangibles, okay. Some intangibles might be very good, definitely. They drive the value, okay. If you're more towards service-oriented company, your value is more towards the service you provide to your clientele, okay, to your customers, okay. Which is, there's no value you can attach to it, okay. Having good employees, okay, you may not attach to it. Having a strong management team, there might be no value you can attach to it. However, that's what makes the customer come back to your business, okay, to bring your business to make you to man profit, okay. However, in this method, we have ignored all that together, okay. Also, in the case of the company you as an investor, you want to buy for continuation, okay, then these might not be the best one to use, okay, because your main concern is about the future income, okay. However, when it comes to this valuation method, We are not considering the potential income that might be earned in future. Okay, there's no of going concern. Okay, we include the analysis. Okay, so anything about the future is ignored. Therefore, in case you want to buy the company for future purposes, then this method might not be the best method. Okay, because this method is assuming that this liquidation that is going on right now. Okay, the company is liquidating right now. Okay, therefore it gives the current value of the company if the company closed down today. But in case you want to buy the company with the aim of continuation, then you can't use this method. Or rather, this method is not advisable to use. Okay, because it only gives you the current values. Clear? Zita is clear?
Yes.
Great. Let's say the use of the net asset value method, the use of the net asset value method, okay, the NAV method. Okay, if there's no question, then you go to the next method, okay, the use of the price earnings ratio method, the PE ratio method, okay. And the PE ratio method, okay, yeah, I think we have already discussed it in the past, okay. In a PE ratio, this is the PE ratio, or PE, okay, is equal to MPS divided by earnings per share, okay. It's simply what is the market appreciation of the company's earnings, okay? That for every dollar of company earnings, how much value does the market attach to that earning? So, for example, we get a P ratio of 10 times. Now, what does it mean? It means that for every dollar of earnings of this company, the market gives a value of $10, okay? For every dollar of earnings, or for every shilling of earnings of this company, the market is giving a value of 10 shillings, okay? That's what it means. What it means, therefore, if we have here been company A with a P ratio of 10 and company B with a P ratio of 15 times, then it means the market deems company B to be more valuable than company A, okay? Because it has a higher P ratio. The market is giving it higher value. The earnings of the company are valued more by the business, by the market in company B compared to company A, okay? Because it has higher P ratio, the market appreciation of the company's earnings, okay? These are the PE ratio method, okay? We imply therefore, if you know the PE ratio, okay, and you know the earnings of the business, then you can get the MPS, okay? Therefore, the MPS, the market price per share, therefore, will be equal to the PE ratio, okay, times the earnings per share, okay? The PE ratio times earnings per share. And let's get the market value of the shares of the company or market value of the business of the company, okay? Simple as that. Okay. Then you can also use what we call earnings yield method, the earnings yield method. Now, earnings yield is a reciprocal of the P ratio. It is a reciprocal of the P ratio. Okay, P ratio was equal to MPS divided by earnings per share. Reciprocal is equal to earnings per share divided by MPS. Let's give therefore what we call the earnings yield. Okay, as far as the earnings yield. Okay, the earnings yield method. Okay, here it's just like the way we've just done it. That if now we know the earnings yield, okay, if we know the earnings yield, we know the MPS, we can get the market, you know the earnings per share, we can get therefore the MPS, which will be equal to the earnings per share of the company, we divide by earnings yield, okay? Let's give therefore the market price per share, okay? If, however, there's a growth in earnings of the company, if, however, we have growth in earnings of the company, then we need to factor in the growth, okay? Yeah, therefore, the market value of the business, or the MPS, is earnings, okay, 1 plus the growth, okay? We divide by the earnings yield. This is earnings yield, not cost of equity. So here, I mean, this equation should be equal to earnings of the company, okay, 1 plus G, where G is the growth in the earnings. We divide by earnings yield, okay, minus G, okay? It's not because of equity, okay? It's not because of equity here, okay? It should be earnings yield minus growth in earnings, okay? To give therefore the market value of the business. That is in case there's earnings growth, if there's earnings growth, okay? That's how therefore we get a market value of the business. Question, Daniel? Daniel, any question?
No, I'm okay.
Okay, great. Okay, there's the use of the earnings yield method as an appraisal technique or determining the value of the company. Then you have what we call the cash flow based valuation. The use of cash flow based valuation, for example, the use of the dividend growth model, which I think you already discussed together in the past when we were determining the cost of equity. Okay, it's the market value of the business. Okay, using the earnings, using the dividend growth model. Okay, was equal to P naught. If you remember, is equal to D naught 1 plus G. Okay, cost of equity minus G. Okay, this is a method we've already discussed. Okay, so yeah, it's very similar that we can use regards to valuation of the equity shares. Okay, always should remember the assumption which I think we did put when we're getting the cost of equity for this particular company. Okay, go through it in the next 1 minute. Then we attempt a question from the past paper. Okay, required using the dividend discount cash flow valuation method, determine the current value of the one of the shares of this company. Okay. So we told that the dividend we paid, okay, the company has been paying an average of 1.5 per share in the most recent years. Okay. The dividends are expected to grow at a rate of 10% for the first 3 years. Year 1, year 3, 10%. Then at 8% for the next 2 years, therefore year 4, year 5, and thereafter at 5%. Okay, so you can have year 1, year 2, year 3 at 10%, year 4, year 5 at 8%, thereafter at 5%. Okay, therefore the dividend or the cash flow, the dividend, therefore for year 1. Currently, the dividend is 1.5. Okay, in year 1, by the time we are in year 1, it has grown by 10%. Therefore, at the end of year 1, it will be equal to 1.5, okay, times 1.1. At the end of year 2, it will be 1.5. 2 years later, 1.1 squared. Okay, 3 years later, 1.5 times 1.1 to the power of 3. Therefore, what the dividend for year 1? 1.65. Year 2, 1.8.
1.5.
Sorry, 1.815.
815.
1.82. Okay, fair enough. 1.82. Okay, year 3, 2 points.
1.9965.
Sorry, you 1 point?
9965.
So $2 therefore. The nearest $2. It's $2, okay? Therefore, in year 4, okay, the growth, year 4, year 5, the growth is 8%, therefore, it'll be $2, okay, times 1.08. Year 5 will be $2 times 1.08 squared. Well, this is 2 years later, okay? Therefore, we get 2.16. And year 3, you get 2.3.
$2.333.
So 2.33 comes for what will be the dividend we paid for year 5. Okay. Now from year 5 onward, the growth is 5%. Okay. And if you remember, we said a P naught is equal to D naught 1 plus G, okay, minus cost of equity minus G. Okay. Don't forget, G here is the growth to infinity, and therefore in this context, the growth to infinity is 5%. Okay. Therefore, let's apply this formula. Okay. So the growth to infinity, the G here. Okay, this is the growth to infinity. Start in year 5. Therefore, this is not D naught, but D5. Therefore, D5, okay, 1 plus G. Don't forget the growth to infinity starts in year 5 going forward. Okay, therefore, that's why we use D5 here. We divide by RE minus G. So since I've used D5 here, this will be P. Don't forget the G here is a growth to infinity, okay? With the growth to infinity begins year 6 onward, okay? Year 6 onward, okay? Therefore, since you have used D5, this is BP what?
P5.
P5, of course, will be P5. Okay, now this again, therefore, the share price at year 5. Okay, the share price at year 5. Therefore, the share price at year 5, P5, will be equal to D5. Dividend for year 5, we have it here, 2.33. The growth to infinity, which is our G here, no, this is a G. The growth to infinity is equal to 5%, 1.05. Okay, cost of equity, 12%. Minus 0.05. Therefore, what's the P5? The share price at year 5.
$34.95.
234.95.
0.95.
Okay. Therefore, in year 5, the share price then. Let me add year 5 here. The share price then is equal to 234. This is P5.
34.95.
234.
34.
Oh, 34. Not 234, but 34. Which is which?
Yes, 34.
34.95.
Yes.
Okay, 34.95. Okay. Therefore, those are the cash flows. Year 1 all the year 5. Don't forget here, year 5 represents the P5. I hope you understood the concept here. This year 5 is for the P5. It represents all the dividend paid from year 6 to infinity. Okay, from year 6 to infinity. Therefore, we discount them back to year 0 at the cost of capital, in this case 12%. Okay, then we get the present value. Okay, so this is from the table. Okay, so you get discount the back to year 0 at 12%. Then get the present value and you get the sum of present value, sum of PV. What do you get to be the sum of present value? And be careful, in year 5, we have 2 cash flows. Okay, year 5, we have 2 cash flow, the dividend and the P5. So you discount them as a year 5 cash flow. Okay, if you're going to make a mistake, then just sum them up together and you discount them as individual cash flow. If you know you're going to make a mistake. So you discount them back to year 0 at 12%, get the sum. And the sum will be the cash at the present, the market value of the share. 83.
Yes.
26.88. Okay. Someone confirm that value. 26.88 to be the sum of the present value of all these dividends.
I have 27.88.
27.88. Okay. Someone else?
87.
26.87, 26.88. Okay. Another answer?
$473.
47. Okay. Year 2.
45.
1.45. Year 3.
43.
1.43. Year 4.
37.
1.37. So year 5, did you discount individually or did you sum them up together?
Individual. I did it individually.
Okay, year 5, the D5,
1.32.
1.32, and the present value that 4.95,
19.83.
19.83. What factor do you use to discount year 5 dividend?
0.5674.
Okay, for P5,
0.5674.
okay, great. Okay, because the concern here is that you end up discounting this P5 as your 6 cash flow, which is wrong. But since you've done the correct way, that's okay. The sum you get 26.88.
Yes.
Okay. So whoever got 27.88, how did you get 27.88?
And for year 5, I like summed them up and then discounted.
Okay, well, okay. So Mary, I think, was that Mary?
Yes.
What the sum of this year 5 cash flow, the two of them combined?
I did individually. I'm not the one who combined.
Okay. So you get in amount. Let's just sum them together. So you get 21 point. This is 5. This is 21.15. Okay. So the person who discounted them as two cash flows. What do you get the present value? The one who combined them. I can't remember what it is.
22.16.
22.16.
Yeah.
Yeah, I think that's where the difference coming in. Okay. I'm not sure now. Okay. Add them together. So add these cash flows together. 2.33 plus that 4.5. What do you get? Well, you got what? That 7 point. 2.33 plus that 4.95. You got that 7 point something.
That's 7.28.
7.28. Okay, times 0.56. The 5674. What do you get?
21.15.
21.15. Okay. And then you check on the one who got 22.16. Check where you made a mistake. Okay, so therefore we get therefore the present value, okay, to be the sum of the market value per share to be 26.88. Now the question is that 1,000 shares, just multiply, okay, it's quite easy, just multiply, okay, therefore market value, okay, for 1,000 shares, therefore be equal to 1,000 times 26.88, and get 26,880. Simple as that. Okay. Any question on that question? If there is no question, the same sitting question 2b. Same sitting question 2b. Okay, same sitting question 2b. Okay, so go through it. We discuss together. May 2019 question 2b. Okay, go through it. We discuss together. Okay. Assuming is to get the current value per share using the dividend growth model. Okay. The current earning per share is 4. The company has 10 million shares with a payout of 40%. The equity capital of 200 million with a minimum of 18%. So really the question, this one. Okay. Here, there's no what we call a staged growth, like in the example you've just done here, where the growth in the dividend is staged. Okay, year 1 to year 3, year 4, year 5. Okay, this is not the case here. Therefore, should be a pretty easy question. Okay, so first we need to get the dividend, the earnings per share, is equal to $4. The company pays 40%, therefore we pay 40% the dividend, which therefore be equal to $4, that's 4 shillings times 40%. To give therefore the dividend to be 1.6. Okay, P naught is equal to D naught 1 plus G. Okay, cost of equity minus G. Therefore, P naught therefore will be equal to current share price is a dividend 1.6. The growth in between will be equal to is not given, so we need to get the growth. Okay. Growth in dividends, if you have to use the Gordon's approximation method, is given as B times R, where B is a retention ratio, R is the return on equity. Okay, the company pays 40, therefore they retain 60. Therefore, B is 60%. Return on equity, we need to work that out. Return on equity is given as net income. We divide by equity, and of course we express this as a percent. Okay. The net income is equal to the earnings of the company, is equal to 4, okay, which means that the total earnings of the company is 4 because the earnings per share, therefore total earnings is 4 times 10 million, where 10 million is the number of shares. We divide by equity, and equity is equal to 200 million, and we express this as a percent to give us how much with the return on equity. Don't forget, earnings per share or the net income per share is 4, and the company has 10 million issued shares. Therefore, total net income, and therefore 4 times 10, we divide by equity, 200 million. To give us how much to be return on equity?
20%.
20% return on equity. Therefore, R 20%. We give therefore growth of 12%. Okay, having done that, therefore, we have all the variables to get the P naught. P naught therefore is a dividend, which is 1.6. Growth is 12%, 1.12. Cost of equity 18% minus 0.12. To give us how much with the share price?
$29.87.
87.
Yes.
Okay, 29.87 comes for the share price for this company using the dividend growth model. Any question? Okay, no question. Seems it was clear. The question was clear to all of you. Okay, 2018. We have another question here. November. Oh, this is yes, November 2018. November 2018. Question 3C. Yes, 3C. 2C. 2C. Yes, November 2018. Question 2C. Go through it. We discuss together. Okay, suppose go through it. You're meant to get to advise whether the shares of the company, whether should buy, whether this investor need to buy the shares of the company or not. Okay, definitely you need to compare the current value 55 versus the true value of this share using the Gordon's growth model. So the first thing, of course, is to determine the growth in the dividend for the past years. Okay, therefore the growth in dividend is equal to D 2017 when you divide by D 2013. Okay, and you have 4 years of growth of the power of a quarter minus 1, therefore be equal to 1.8 divided by 1, the power of a quarter minus 1, and you get how much with the growth in the dividend? What's the growth?
$0.158.
So in percent,
In percent, it's 15.883%.
15.83.
Yes.
83%, 15.83%, because of the growth in the dividend from 2013 to 2017, the annual growth in the dividend. Someone confirm that value?
Yes, it's correct.
Great. Okay. Therefore, P naught, the current share price, okay, is equal to D naught, the most recent paid dividend, 1 plus G, okay, cost of equity minus G. The D naught, okay, paid as 2017 is 1.8. F1.8, the growth in dividend is 1.1583. The cost of equity, you've been told, is equal to 20%, 0.2 minus 0.1583. Give us how much?
50.
Exactly 50.
49.99.
Okay, 50. Okay, 49.99. Okay, so then we get 50 to be the value of this share. So would you advise the investor to buy this share? Would you advise the investor to buy the shares of this company? The answer is before your eyes.
No.
No, the investor should not buy the shares of this company since the current market price, 55 shillings, is higher than its true value, its intrinsic value at the price of 50. So therefore, the shareholder should not buy the shares of this company. The true value of these shares is lower than the market value of 55. Okay. Okay, you meant to advise. So you need to write down what you just say together. So another question here we can do. I hope you've done the advice. May 2017, question 5D. May 2017, question 5D. Okay, let's do it together. Using the dividend growth model, determine the optimum retention policy for this company. Okay, the earnings of the company this year was 6. Okay, all the investments, the number of investments in the company, there are a number of investment opportunities available for the company. Although if it does not undertake the investment, its annual return and expected to remain at 6 million in perpetuity. Okay, therefore, return on investment. Okay, growth in earnings of the company. Okay. So if currently the company pays all the dividends, okay, that is, they have 0 retained earnings, okay, therefore, even they earn, they pay as dividend, then you can see, therefore, the value will be equal to the earnings of the company, or rather the dividend, okay, because all earnings paid as dividend, okay, therefore, will be the dividend, which is 6 million, no growth, but due to the cost of capital will be 16%, therefore, divided by 0.16. To give us how much?
37.5.
That's 10.5 million. Then the next policy, the company they retain 30, it means they pay 70. If that happened, therefore, if they retain 30, they pay 70, okay, then to the company, therefore the dividend, okay, for the company, then will be equal to 20% of the earnings, okay, which remain at 6 million, because therefore 4.2 million, because therefore the dividend paid by the company, okay, therefore the market value of the company will be equal to, okay, 4.2 million. Okay, we assume the payout is remaining constant, and therefore, if the earnings are growing by 6%, and with the payout, the dividend grows by the same rate, okay, at 6% times 1.06. Cost of equity is now 20%. The growth is now 6%. To give us how much of the company's value if it use the growth model.
$40.47.
40.47 million. Okay. The next policy, the company retains the 45. It means they pay 55. They have the dividend, then will be equal to the dividend. Then they'll be equal to 55% of the earnings, 6 million. And you get how much with the dividend?
$3.3. 3.3
million. Okay, therefore, the market value of the company therefore be equal to the dividend, 3.3 million. They grow at a rate of 9%, 0.09. Okay, cost of equity is now 19%. Okay, minus 0.09. To give us how much the company market value?
$35.79.
35.79 million. Okay, that's 10.79 million. Okay, therefore the company's value, if the company was to retain 45%. So which was the optimal? Of course, the one that maximizes the company's value. If we don't pay the dividend, there's a value. If we pay the dividend 70%, there's a company's value, and there's a company's value if we follow 45% retention policy. Therefore, this is therefore the optimal. Okay. Therefore, is the optimal. Therefore, the company therefore should have, or the optimal retention policy is 30%, because it has therefore the highest or the maximum, the highest of market value to the company at 40.47. Okay, therefore this is therefore the optimal policy, the optimal retention policy, 30%. Okay, great. Let's do company valuation. Let's do the question that asks us to do valuation for those who have gone through the question. So required. So you're meant to get the company value using the following method: market cap, net asset value, get the PE ratio, okay, and the dividend growth model. Okay, so I think this question sums up all the different methods we have been discussing. Market cap. Okay, so let's begin by getting the market capitalization. Okay, market cap. Okay, market cap is simply the total market value of the company share. Okay, therefore is the number of shares of the company. Number of shares of the company we multiply by the current share price by the market price per share. This company, the number of shares it has. Okay, if we go as per the balance sheet, the total nominal value is 20 million. The nominal value per share is 0.5, therefore divided by 0.5 to give therefore the number of shares of this company. We multiply by the current market price per share, which is equal to 4. This gives therefore 160 million to be the total market value of the company share, okay, using the market cap as the method. The next one we need to use the NAV, is equal to total assets of the company minus total liabilities. In this example, you'll be told we use the historical cost basis, the liquidation basis, sorry. We use a liquidation basis that in case the company was to sell off the asset, how much will it fetch in the market? If the company disposed of the asset, the non-current asset, they would fetch 86 million. The inventory would fetch 4.2 million. Not sure what has happened to my pen. Give me a second. Okay, back. Okay, then current assets, the inventory is 4.2 million. Okay, then we've been told the receivables we expect to get as they are. Okay, I don't know, 80%, only 80%. So you're only going to be getting 80%. The 20% will not be received. 80% therefore of 4.5 million. Okay, that's what therefore we expect that to receive from the receivable. Okay. And that is it. That's the only inventory, non-current inventory. Yes, that is it. That gives the total assets of the company. Okay. We minus total liability, both current and non-current. Non-current, they are 25 million. Current, we have 7.1 million. And that is it. Total asset of the company minus total liability. And that is it. And we get how much? To be the net asset value. Hey, how much do you get?
108.3.
That's too high.
61.7.
Yes, that sounds a bit correct. 61.7 million. Okay, 61.7 million. Okay, okay, this is a minus sign. So I hope you didn't add. Okay, it's a minus sign. Okay, we get 61.7 million to be the NAV. Okay, the next one we're going to use is the price to earnings ratio, you were to use the business sector average as a method of valuation. The PE method. PE method, we mentioned is giving us the market value of the company or the MPS. If you want to do per share, we divide by the earnings of the company. Okay, this can be market price per share. If you want to do per share basis, divide by earnings per share. Okay, so we want to get the market value of the company. Therefore, market value of the company is therefore equal to the PE ratio. We multiply by the earnings. Multiply by the earnings. Okay, this is therefore equal to the PE ratio. We've been told the PE ratio for the business sector is equal to how much? 17 times. 17 times. Therefore, you multiply by the earnings of this company. The earnings of this company is how much? The earnings of this company, the most recent year, which is in year 2012, the profit after tax for this company was 10.1. Therefore, earnings 10.1 million. And get 171.7 million, I guess, to be therefore the company market value if you had to use the PE ratio, which is the price to earnings ratio, which is 20 times the earnings of the company, the profit after tax as at year 2012, which is 10.1 million. Confirm this.
It's right.
So 121.7 million for the company value if you had to use the PE ratio method. What is the company's value in case you to use the Gordon's growth model? Okay, P naught is given us D naught 1 plus G. Okay, cost of equity minus G. So first we need to get the D naught, and the D naught as per 2012 is 6 million. So we have it already. The growth in dividend in this example, you to use the historical growth in dividend. Number one, use historical growth in dividend, which therefore is equal to G is equal to D 2012 divided by D 209. Okay, how many years of growth? 3 years of growth, the power of a third minus 1. Therefore, this will be equal to 6 million divided by 5 million. This growth has been for 3 years minus 1. Because how much is the growth in the dividend? If you were to use the historical growth.
$6.26.
6.26.
Yes.
Okay, 6.26 for growth in dividend over 3 years. Okay, well, cost of equity have been given to us. Cost of equity, yes, 9%. Cost of equity is 9%. Therefore, P naught is the dividend 2012, which is 6 million. The growth is 6.26%. Cost of equity is 9% minus the growth 0.0626. Because how much of the company value if you were to use the Gordon's growth model? 2.
To 32.67.
2,620,000. Okay, that in case we are to use to get the G based on the use of the historical growth in dividend. Then you meant to get the G using the Gordon growth model. Okay, where G is equal to B times R. Okay, therefore R being the retention ratio. So in case you use as per the year 2012, the retention ratio. Okay, the company paid 6 million, and the earnings for the year was 10.1. Therefore, they retained 4.1 million. Okay, out of 10.1 million. Okay, because the company retention ratio. The company paid 6 million. They retained therefore 4.1 million out of the earnings of 10.1 million. In percent, we get 40 points.
$40.59.
59.
Yeah.
If you get the return ratio, it would be 40.59. return on equity, okay, not sure it's given. If it's not given, then you have to do it. Return on equity, ROE, is therefore net income. We divide by equity, net income, divide by equity. The earnings of the company will be told is equal to 10.1 million. That's the net income of the company, 10.1 million out of the 40 million shares. Okay, dog, this company has 40 million shares. Okay, we divide by the equity, and the equity for this company is equal to the 40 million shares of this company. Just a minute. 20 million is the 40 million. Oh, this is total earnings. Sorry, you don't need to multiply. But the 10.1 million is total earnings of the company, not the earnings per share. Divided by equity, and the equity for this company, if you look at the balance sheet, is 67. It's 67.2, 7.2 million, and we express this as a percent. Earnings, ordinary share is 20, reserve for 7.2 to give us 7.2 million. Therefore, return on equity is how much?
$15.03.
15.03%. Okay. Therefore, G is equal to B, which is 0.4059 times 15.03. And we get how much? To be the growth in the dividend. 6.1. 6.1, okay, 6.1 with the growth in dividends. Therefore, P naught is equal to the dividends, 6 million. The growth is now 6.1%. Cost of equity remained at 9% minus 0.061. Give us how much? 2.
$219.52.
219.
219.52.
219.52. 219.52. Okay. Great. And that's on how to get the cost of, to get the market value using the dividend growth model. Okay. 19.52. Question. Okay, no question. Now we are meant to do our mock. I'm not sure when you're meant to do the mock. Let me just confirm that right now.